Hello learners. Necessary improvisations have been made to improve the audio quality as far as this lecture video is concerned. Thank you for reminding us. It is always a pleasure to attend to your queries and doubts. This lecture video will help you to understand about accounting treatment with regard to various adjustments. In the previous questions, we would have dealt with questions without adjustments, which means simply posting of the trial balance items into the trading profit and loss account, and we would have prepared the financial statement balance sheet. In this question, it is going to be like the trial balance will be given. Along with the trial balance, there will be a couple of adjustments. After closing of the trial balance, some of the adjustments are given. So, how to give effect to those adjustments is what we are going to deal with in this lecture video. I hope you will have a good time in learning this. Be in touch, and always you can come back to us in case of any query or doubt. Thank you very much.
In this session, we will take up a comprehensive question where we will deal with how to prepare trading and profit and loss account with few new adjustments. We will look at, as we have done a couple of problems earlier, the basic methods remain same. In addition to the routine procedure of preparing trading account, we will be dealing with the treatment with regard to additional adjustments. So as usual in a question, this is a trial balance of a business concern for the period ending 2011 and balance sheet as on that date. You are asked to prepare balance sheet as on that date after preparing trading profit and loss account. For this purpose, details with regard to building, value of machinery, furniture, bank balances, cash balance, and loan taken by the firm, capital, debtors and creditors, details with regard to opening stock, purchases, and returns. Purchase is a debit item and return here is a sales return. And details regarding sales and purchase return is given. Rent, establishment, PF deducted from salaries is given as credit item. And 10% borrowings, interest at the rate of 10% for borrowings is given as rupees 2,000. Electricity charges, phone, all these. So these are all some of the expenses to be shown on the P&L account as usual. P&L account. Establishment expenses, also P&L account. Rent, also P&L account. Your sales and sales return, purchase return ought to be given effect in trading account. Building asset item, balance sheet, asset, balance sheet asset, again machinery asset, bank is a current asset, cash balance also, all these are to appear in balance sheet. Capital, balance sheet liability, and provision for PF as given in question should be shown on the liability. This PF deducted from salaries to be shown on the balance sheet liability. Additional provision is given in case of adjustment, that should also be given. Commission, if it is given in debit side, it is P&L debit, P&L account debit item. Insurance premium also P&L account debit. Bad debts is a loss, P&L debit. bills receivable, again asset to be shown on the balance sheet. Then total of the trial balance is given. Adjustments, we are asked to provide depreciation on machinery, building at the rate of 5%. So we can even work out depreciation here. So building, so we have to check value. Value of building is 50,000. 50,000 at the rate of 5%. So 2,500. Machinery, value of machinery we checked 22,000. There is no additions, so 22,000 is the value as per trial balance, on which 15%. So 10% is 2,200, half of which is 1,100. So it should be 3,300. Any machinery related adjustment is there during the machinery was destroyed by fire, and 2,000 was loss. So in that case, if that adjustment is given, there is a loss of 2,000. So 10,000 rupees machinery got damaged and insurance company settled only 8,000. That means 10,000 minus 8,000, there is a loss of 2,000. So we have to subtract this amount and we have to calculate. So we cannot calculate here for 22,000. Instead, we have to calculate for 20,000 instead of 22,000. Why? Because 2,000 is loss, on which 15%. So it should be 3,000. Are you able to understand why this 3,300 is not right? This 22,000 on which we simply calculated at the rate of 15%. As we have noticed that there is a loss to the tune of 2,000. So we have to reduce that amount. We cannot claim depreciation for the machinery which is not existing. So we have reduced it. We have taken it, removed it. The calculation made for 22,000. And the question also says furniture 10%. So for find out the value of furniture, 10,000. 10,000, the value of furniture, on which 10%. Is that Pudha?
Yeah.
So on furniture, value given as rupees 10,000, on which 10%. So the total amount of depreciation 5,500 plus 1,000. So this should be debited to P&L account as well as reduced from the respective assets while preparing balance sheet. So on building, it is 2,500. Depreciation. On machinery, it is 3,000. And on furniture, it is 1,000. So we move on to next calculation. It is given stock was valued on 7th January. And transactions from 1st January 2012 to 7th January 2012 are given pertaining to sales, purchases and stock on 7th January 2012. Stock was not valued at the end of the year. It was valued on 7th January 2012. So, closing stock to be taken as such on 7/1/2012 as 18,000, and your sales from 1st January to 7th January 2012 sales is given as rupees 25,000 less gross profit, that becomes your cost, which is 20%. Gross profit is given as 20% on sales, nothing but 5,000. So on 20,000 less purchases, less purchases, $5,000, sorry, 15,000. So your closing stock will be totally 23,000 to be shown on the trading account credit side, closing stock. So this is stock on 7th January as given in question. Apart from that, it is given between 1st January to 7th January, there was sales for 25,000 at a profit of 20%. So 20% on 25,000 comes to 5,000. Subtracting profit from sales, you get the cost or cost of goods sold, from which if you reduce purchases, you get the stock for this period, for these transactions. So total stock to be taken on 31st March or what's the date given here, on 31st December 2011 will be rupees 23,000. This is how the stock to be valued in this question. Moving further, the third adjustment we already looked at. Here in this case, your closing stock $2,000 loss to be debited to P&L account, and the 8,000 will be shown in the balance sheet asset side. The amount recovered from the insurance company will be shown on the balance sheet asset side. Normally, when the amount recovered from the insurance company to be shown on the balance sheet asset side, whereas here in this question, it is given, it is credited to machine account. So we have to presume that on the machinery value of rupees 22,000, there is a loss of 2,000. This machinery account in which this 8,000 has already been credited So this need not be shown in balance sheet again. So we have to subtract 2000 towards loss, and depreciation should be adjusted to the tune of 3000. Less depreciation 3000, and the balance of 17,000 should be shown in balance sheet. When wordings like credited to machinery account is not given, if settlement made outside the balance sheet, this should be adjusted. This should be shown in the balance sheet asset side. Similarly, in the fourth adjustment, employer's share of provident fund is given as an adjustment item. This will appear in P&L account as well as in balance sheet liability. Provision to be made. You are asked to provide for employer's share of provident fund. So this will have to be a provision has to be created, which means it should be shown in the P&L account as well as in the balance sheet liability. And provision for doubtful debts to be made at 5%. So first, for that we need to check the debtors. Amount of debtors 50,000, on which 5% 2,500. So 50,000, 5%, nothing but 2,500 should be provided as additional provision for bad and doubtful debts. And manager's commission, after providing the commission to be valued as the net profit, to be presumed as it is inclusive of manager's commission, and on that amount 10% is to be calculated. I'll explain it while calculating the net profit. We can now go on to preparing trading account. So we looked at the items given in the trial balance, and we looked at the treatments with regard to the adjustments. Now we prepare trading profit and loss account. For the year ending 31st December 2011. So credit and debit to opening stock. First we have to start with the opening stock, or we can go by items, not an issue. In that case we can go by ledgers this question. Okay, to opening stock, which is given as 12,000. Opening stock 12,000. Then purchases, is 2,50,000, and purchase return is 10,000. Purchases will be given on debit and purchases return will be given on the credit side. So to purchases 2,50,000 less returns 10,000. So 2,40,000. By sales, checking the data in the trial balance, the amount of sales is given as 3,22,000. Sales is a credit item. It will be given on the credit side. 3,22,000 less returns 12,000. So it is 3,10,000. By closing stock, we have already calculated. You have to take this number 23,000. We already, so here it was given, balance sheet was not valued on 31st December 2011. It was valued on 7th January 2012. And the transactions sales given at a gross profit of 20%. So subtracting gross profit, you get the cost from which you subtract purchases. So you get a value of closing stock for the transactions between January 1st to January 7th. Adding it up with the stock on 7th January of rupees 18,000, you get a total stock of rupees 23,000 to be credited. 23,000. So by closing the ledger, so credit exceeds, so 3,33,000. So the difference of 81,000 is your gross profit. This should be credited to P&L account. I'm just continuing P&L account. So by gross profit, $81,000. So I'm recording all expenses by referring to the trial balance. So it starts with the rent. Rent rupees 6,000. There is no outstanding or there is no prepaid rent. So I'm just extending the amount to the outer column. Rent rupees 6,000. Then going by the trial balance, establishment is 16,000. Establishment 16,000. Then interest at the rate of 10%. So your loan is 30,000. Loan was borrowed on 1st January 2011. So 30,000 is your loan money and your interest rate is 10%. So in that case, it must be 3,000 is your interest for the year, for 1 year, 10% per annum. Whereas you have shown only 2,000, that means 1,000 rupees is outstanding. So while recording it in the P&L account, to interest plus outstanding 3,000. It is 2,000 is your interest what you have given in your trial balance and 1,000 rupees towards outstanding. So given effect. Next item is electricity and phone, each 1,000. So to electricity charges 1,000. Phone expenses 1,000. Then commission, insurance premium. Commission given in debit side, so to be written on the debit side of the P&L account. So commission amount commission 6,000, insurance premium 1,000. Insurance premium, in case of any adjustment, prepaid insurance or anything given, should be subtracted. Otherwise, directly we can enter insurance premium. Insurance premium 1,000. Bad debts rupees 2,000. It is given in trial balance, so it should be taken as directly as a loss to be debited to the P&L account. To bad debts, $2,000. Provision, $2,500. Provision for bad debts at the rate of 5% on 50,000. So provision for bad debts, bad and doubtful debts. Then bills receivable is balance sheet asset item. Onto the credit side, loan is a balance sheet liability, capital balance sheet liability, purchase returns adjusted. Then there is no income given. So we have to give effect to depreciation. To depreciation. To depreciation, totally 2,500, 5,500, 6,500. So on furniture, any adjustment, furniture 10%. Okay, value of machinery, furniture. So 6,500. Depreciation. So almost all items have been given effect. So now close the ledger. Find out the balance. If you look at it, it is 22, 25, 26, 27, 33, 34, 36, 38, 38, 44, 45,
7 was that?
Here, if you look at stock destroyed by fire, there is a loss of rupees 2,000, which should be debited to profit and loss account. So, to loss of machinery, $2,000. And provision for employer's PF contribution, which is also missed out. I'm just adding it. It is given in adjustment A, which is employers, to provide for employers' share of PF, rupees 1000 to be provided. So which means it should be debited here. Provision for PF. So you will get a profit of as such workings. I'm doing workings now. Net profit, what you get as such is rupees 33,000. That means if you look at it, 7, 23, 26, 28, 34, 35, 37, 39, 38, 44, 43. So it must be 48. So total of credit side comes to rupees 48,000. So the net profit becomes 33,000. That is 81,000 minus 48,000. You get a profit of 33,000. And you are asked to provide for manager's commission at the rate of 10%. That is after providing such commission. So in such case, when it is given, we should presume that if 10% means adding, if 100 rupees is net profit, add 10% commission, which is nothing but 10 rupees. So 110 should be taken equal to rupees 33,000. We should presume that this, when it is given after charging such commission, we should presume that this 33,000 is inclusive of the 10% of manager's commission. So in that case, what is 10% can be calculated, which should be nothing but 3,000. That means after charging 3,000 of manager's commission, the profit should be subtracting 33,000 from 3,000 the commission, you get net profit of 30,000. So how this should be recorded in P&L account? In P&L account you have to write these aspects on the debit side to manager commission. $3,000. So that means out of 81,000, now it will be 51,000 after adding this 3,000 of manager's commission. So the final net profit, as there is no space, I am writing over here, rupees 30,000. Is it clear? Is this calculation is clear? I would like to again reinforce the calculation here. Why do we do this? We have arrived as 33,000 as net profit, and on which we did 10 by 110. Why? Because it is given in question, manager's commission is to be provided at the rate of 10% after charging such commission. So on 33,000, we calculated 10 by 110. This 33,000 is to be arrived after charging. So this 33,000 should be taken as inclusive of. So if net profit is 30 rupees, or if net profit is, the manager's commission is given as 10%. That means if net profit is 100, manager's commission is 10%. That means it should be 110 rupees, which is equal to 33,000. Means what is 10% can be calculated. This is nothing but 3,000. So after charging such commission, your net profit is 30,000, on which 10% directly, if you work out 10% also, you get the same 3,000. Can be either way. Now we move on to prepare balance sheet. As on 31st December 2011. 2011. So balance sheet as on 31st December 2012. Here are your assets, and you will find all your capital plus liabilities. So we'll start with the order of permanency. We'll take up all fixed assets, then move on to current assets. Similarly here, capital to current liabilities. Capital, then current and other liabilities. So when we go back to the trial balance, find out values of items to be shown on the, first we'll start with assets. So you have building 50,000. So on the asset side, building, inner column 50,000 less depreciation, $2,500. So 47,500 is the value on this date. So machinery. So next item on the trial balance is machinery. $22,000. Less loss, 2,000. Loss by damage due to fire. So on 20,000, it is 15%. So 3,000. So balance 17,000 is the value of machinery at the end of the year. Furniture 10,000 less depreciation 1,000. So balance 9,000. Then there is no fixed assets, I think, other than this. So we have entered building, machinery, furniture, all these aspects. Then current assets, stock, closing stock as per valuation on 7th January, 23,000 to be taken there to the stock, 23,000. Debtors Value of debtors as per question 50,000. Bad debts is trial balance item. So we have to create only the provision at the rate of 5%. So 2,500 provision. So since bad debts, additional bad debts is not given, we can simply write subtract provision and extend the balance to the outer column. So the debtors value as per trial balance is 50,000 less provision for doubtful debts. For doubtful debts 2,500. So 47,500. So stock debtors, bills receivable if given, bills receivable given as 4,000. And bank balance and cash balance. Balance as per bank. $9,000, cash rupees 1,000. So cash and bank $10,000. So on to the liability side, capital. As per trial balance, capital is 52,000. We have to check whether drawings is there. If drawings is there, it must be reduced. There is no drawings given. Interest on capital is not given. So if interest on capital not given, we have to add along with the opening capital. Opening balance 52,000. Add net profit 30,000. So 82,000 is your capital. Loan as given in question, it is 30,000. We have creditors. So first we enter the loan. Loan 30,000. So interest on due on loan. So there are no other long-term liability. So moving on to the short-term liability, interest due, interest outstanding is 1,000. Creditors, how much is value of creditors? 40,000. Provision for employer's share of PF. Provision for PF. So employer's share to be provided for was given as ₹1,000. ₹1,000. And manager's provision for manager's commission. $3,000. So I think almost we have given effect to all aspects of both trial balance as well as adjustments. Here the point to be noted is they calculated initially depreciation on the total value of asset of 22,000, but we found that there was loss to the tune of 2,000. So on the machinery which is not existing, we should not provide depreciation. So we reduced it. And on the balance of 20,000, we calculated it at 15%. So this is with regard to this. And this is with regard to this. And furniture, 10% to be provided. So in this question, the important adjustment is that the stock was not taken on 31st December, but it was valued on 7th January. And transactions pertaining to 1st January 2012 to 7th January separately given. So stock on 7th value is separately given. And we need to do adjustment with regard to transactions from 1st January to 7th January for sales of rupees 25,000, against which profit of 20% should be reduced. You get the cost, from which less purchases, you get the stock that should be added. So your total closing stock should be valued, should be taken as 23,000. And on the adjustment, it is given the compensation received from the insurance company is credited to machinery account. So we have not taken into account 8,000. So we have to presume that this 22,000 is inclusive of 8,000. This will not be shown separately in balance sheet. Out of this 22,000, less loss of 2,000, and on that less depreciation, at the rate of 15%, and the balance should be taken to the balance sheet. And employer's share of provident fund is to be provided. So two effect, one in P&L account, another effect is in. So if you look at it, here we have entered 1,000, and we have also shown here in balance sheet provision for PF, which is 1,000. So all adjustment items are given two effects. And commission to manager after charging such commission. So after charging 3,000 of commission, you get a net profit of 30,000, on which 10% also can be calculated. Commission is to be calculated at the rate of 10%. After charging means this is the method by which the commission should be calculated. And the manager's commission is calculated as per adjustment. So it should be shown both on the P&L account debit as well as in balance sheet. So if you close the trial balance,
PF given in the trial balance credit side is a liability item, should be shown on the balance sheet liability side.
You will get a balance of ₹1,58,000.
Hello learners, after listening to the lecture, I hope you would have learned as to how to give effect to after trial balance adjustments. That means some of the treatments or adjustments to be given after the preparation of trial balance. Thank you.